The key to all of this is seeing the deliveries and the lengths. Look at Saudi Arabia and China hiding how much they're buying, not reporting it to the IMF. If the PBOC buys it, it has to be reported. But if the PLA, the People's Liberation Army, buys it, it doesn't. Remember, they're buying all the Dore. If it's not 995 pure, it doesn't have to get reported to the IMF. Look at Saudi Arabia. Oops, sorry, we didn't report it. You got caught on the import-export numbers. All of these countries are doing all they can to exploit the delivery mechanism and buy it around the globe at these stupid fugazi prices that we continue to portray to support the illusion, the strength of our Western system and of our bond markets, and it is coming to an end.
The manipulation of gold and silver markets has been a persistent issue for decades, with experts like Andy Schectman sounding the alarm for years about the ongoing interference by major financial institutions. Despite significant fines, including the penalties faced by JP Morgan Chase for manipulating precious metal prices, insiders suggest that these practices have continued largely unchecked. Schectman, a longtime critic of market manipulation, points to the growing disconnect between paper prices and the surging demand for physical gold, especially in Eastern economies like China. Over the past 25 years, the price of gold has skyrocketed from around $250 per ounce to over $2,600, reflecting a dramatic loss of control in Western markets. This gold price surge indicates a shift in global economic dynamics. Eastern countries, particularly China, have significantly increased their gold reserves while moving away from the West's traditional financial systems. China's strategy to accumulate gold and promote the Shanghai Gold Exchange, focused on physical delivery rather than speculative trading, marks a significant shift in the global precious metals landscape. Andy emphasizes that Russia is also aggressively buying gold to bolster its currency in response to Western sanctions. He points out that Russia recently announced plans to accelerate its gold purchases, expressing surprise that they took so long to take this step. Given Russia's vast gold reserves and its role as a major commodity producer, he believes it was only a matter of time before Russia realized gold's importance as a reserve currency that cannot be easily sanctioned. Analysts are particularly concerned that China and Russia are bypassing traditional markets like COMEX and LBMA, buying directly from miners and avoiding the disruptions that often influence price setting. Andy highlights how China, for example, has been securing large quantities of silver by purchasing concentrated ore directly from mining operations, insulating their purchases from price fluctuations. By disintermediating the market and controlling the flow of physical metals, these nations are positioning themselves outside the reach of manipulated markets. We present the clips of Schectman's insights from his recent interview with Kinesis Money. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
There are larger orders that are being done by more sophisticated investors, and I use the term sophisticated carefully. It's not that they're smarter than the average person, it's just that they're perhaps paying a little bit more attention to their finances and have accumulated a little bit more than the masses. But in general, I would say it's eerily quiet. And it's interesting because we hear all of the issues with tightening on the LBMA or on the COMEX, or 55 million ounces delivered off of COMEX and silver in the month of December. All of these things, anecdotal, that are on the wholesale side, up a few steps above up the ladder, are disconnected from the reality here in the United States retail. And I would say that a lot of it has to do with the euphoria surrounding the Trump win, and rightfully so on many levels. We've lived through what is considered bizarro world, and to get our culture back is a big thing. To get normal back in order is a big thing. And of course, he's being touted as the crypto president. And so there's been a lot of, I think you can say, attention moved from precious metals into other areas. And what I find most interesting about this, I've always been a big fan of misdirection, the art of war. It's pervasive. It's used everywhere, especially at the highest levels. And as the public has been misdirected for really almost a year, if we're being honest, into things like NVIDIA, Bitcoin, and Apple, and cryptocurrencies in general, XRP and all of these meme coins that are making people fortunes. And moving away from precious metals, we see the central bankers doubling down on their efforts, doubling down over the last 2 months of the year, twice what the 12-month moving average is. China and Saudi Arabia doing all they can to covertly, privately, although they've been caught twice now, accumulating gold and listing far less than they're actually buying. In other words, the biggest money in the world, the central bankers who know the playbook, the biggest money in the world who's draining the exchanges off of COMEX and the LBMA, the biggest money in the world that is creating shortages in industrial grade bars are ahead of the curve, where the retail consumer is again being misdirected largely into areas that you could argue on many levels are overvalued and are oversold and or overpurchased, overbought. And I don't know. It's an interesting dichotomy, Andrew, for sure it is. And one that I think if anyone was saying that business in this industry is really brisk, they're not really quite being honest. I couldn't agree more, and talk about how they're doing it. You look at what's going on right now, like, for example, on the LBMA, and the LBMA numbers are so out of whack. It's crazy. They have pretty darn close to $4 billion of London cash spot silver claims with total vault holdings of about 850 million ounces. So you're talking, and there are people there that are saying they're trading upwards ends of 2.9 billion ounces of silver per day, which is 3.5 times annual global mine supply. I don't have the exact numbers in gold. I think they're trading roughly 2.5 times annual global mine supply in gold. And I think what changes things now is that the big money across the globe, in particular the Southern Hemisphere, the BRICS, they understand what we're doing, and they're using it against us. We saw 55 or 45 million ounces delivered off of COMEX in December. There was an interesting comment by the gentleman who is working with the BRICS Grain Exchange, and I would draw a parallel to the Precious Metals Exchange. Rob talked about this on Danny's Capital Cosm show about the exchanges in Brazil, in Dubai, in Russia, in Moscow, in Shanghai, and how they will build a BRICS gold exchange. But listen to the comment the gentleman said about the grain exchange. He says, we produce more grain and consume more grain than the folks do in the West, yet we can't control the prices. It's controlled on COMEX, but with the development of the grain exchange, that will change. They know what we're doing, and they're not bitching about it, probably even adding to these short positions with paper in order to drain the exchanges slowly and methodically, do the exchange for physical off of other exchanges. Rob talked about that in that interview with Danny. He said, look, they can buy and take stuff off of other exchanges, but it doesn't disrupt the price the way it does when it's taken off COMEX, which is the price setting mechanism. You see China going around the world and buying doré and concentrate. 75% of all their industrial silver is now concentrate. They're buying it directly from the miners, disintermediating the marketplace. And this comes from the second largest producer of silver in the world. I said that to David Morgan. He says, well, they're actually the first. That's what they told me. Well, it doesn't matter. It's semantics, first or second, but yet and now net importers instead of net exporters, flying around the world, buying concentrate and doré directly from the miners, which doesn't affect the price, or it's very opaque as to how much they're getting. And virtually no effect on the price. They're pulling out all of the stops, knowing that we're doing this. And the only reason they're not bitching is because they're the ones that are accumulating it. And that's really the key to all this. We're being played by it, and we're being played by our own stupidity. And, Rob has always talked about the London gold pool, and Craig is the one who's always talked about the London gold pool. But if you go back that far, the LBMA is 140 years old, and the COMEX since 1974, all the way until just maybe a decade ago, all of these countries were third world. They weren't challenging or standing for delivery. Nobody did. But now they're sophisticated, they're coordinated, and they're motivated, and they're doing it just fast enough so that we can see it, public doesn't see it, and they're doing it not too fast to disrupt the apple cart. But I think the key to all of this is seeing the deliveries and the lengths. Look at Saudi Arabia and China hiding how much they're buying, not reporting it to the IMF. If the PBOC buys it, it has to be reported. But if the PLA, the People's Liberation Army, buys it, it doesn't. Remember, they're buying all the Dore. If it's not 995 pure, it doesn't have to get reported to the IMF. Look at Saudi Arabia. Oops, sorry, we didn't report it. You got caught on the import-export numbers. All of these countries are doing all they can to exploit the delivery mechanism and buy it around the globe at these stupid fugazi prices that we continue to portray to support the illusion, the strength of our Western system and of our bond markets. And it is coming to an end. And that's why I named my podcast Little by Little, because it refers to the logarithmic decay, little by little by little by little, and bang, all at once. And where are we in the all at once? Where are we on this chain? They know what we're doing. If they know what we're doing with grain, they know what we're doing with precious metals, and they're using it against us. And it too will change.
The Shanghai Metals and Futures Exchange has surpassed COMEX in trading volume, signaling a potential shift in the global precious metals market. This shift is particularly notable because the Shanghai Exchange is a physical market, where traders must own the actual metal before making transactions, unlike COMEX, where trades are often settled in paper contracts. Recently, global investors have been paying attention to the growing liquidity in the East. China's government injects liquidity into its markets, particularly affecting Shanghai's silver, gold, and copper contracts. This surge in liquidity comes at a time when Western markets, such as COMEX, are facing increasing challenges due to their reliance on paper contracts rather than physical delivery. Andy points out that in May 2024, Shanghai's prices for precious metals were 10% higher than those of COMEX, highlighting a growing disparity. This shift raised significant concerns about who holds the true pricing power in the precious metals market, especially with the continued dominance of Western financial institutions. Analysts have noted that the increase in speculative trading on the Shanghai market and a rise in paper contracts are pushing speculative positioning away from the West and towards the East. The government's moderately loose liquidity policies in China encourage more traders to shift towards physical gold and silver contracts. As liquidity continues to flow from paper-based markets like COMEX into physical markets like Shanghai, it signals a direct challenge to the dominance of Western financial systems.
You look at, for example, the BRICS, which Andrew, you and I have talked about a lot. We're very close to issuing their unit gold-backed currency over Enbridge, but at the 12th hour, the BIS and Augustus Carstens pulled the plug. The BIS Innovation Hub was helping China, Hong Kong, Thailand, and the UAE develop Enbridge and also to run the unit settlement token, who Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, said we've agreed in principle to this. Basically, Sergei Glaziev's idea that has now materialized. And at the 12th hour, the BIS says, well, we can't be involved with any country like Russia that's being sanctioned by the West. It's as if they just realized over the last 4 years that Russia was the R in BRICS. And so they've pulled back from this. But in essence, what they are doing until they get a more cohesive settlement currency and a platform to trade over, I think that they realize that the need for the U.S. Treasury is fleeing, and instead they would use gold as a neutral reserve asset to settle their trade surpluses. So, in essence, what you're seeing are these countries who realize the West, whether it be the United States through what he calls, President Trump calls tariffs. They're actually sanctions masquerading as tariffs. You don't say 100% tariff if you don't do this. That's a sanction, and that's a threat. And instead, they're accumulating gold, which has doubled the performance of the 10-year Treasury for the last 25 years, but has no counterparty liability. It's also been reclassified by the BIS as something tier one or high quality liquid asset. And all of these things, you put them all together and it becomes very obvious that these countries have chosen to shed treasuries and to accumulate gold instead of those treasuries. And I think that is a trend that will continue. Absolutely. A comment made by Pierre Lassonde, and recently the cumulative volume on the Shanghai Metals and Futures Exchange combined surpasses that of the COMEX, making it the number 2 most actively traded center for metals. Pierre Lassonde just came out and said the day the Shanghai Gold Exchange surpasses the COMEX in transactions will mark a seismic shift. Gold's pricing power will move decisively from the west to the east. Summed up, the gold price will ultimately be decided not in the United States, but in the East. How close are we from that moment where these fugazi numbers that you can trade at such massive, distorted levels of paper contracts to physical behind it? At what point, like you said, is it over like that? And now the nations who understand and accumulate and respect what these assets really are and what they mean, the pricing will move that way. And what does that say for the LBMA and for the COMEX and for this country, for the whole Western system? You could argue, if Pierre is right, we're close to that happening, because those two exchanges combined, the Shanghai Metals and Futures combined, has now surpassed COMEX. So how far away are we? I'm not sure, but he would tell you probably closer than most people think.
Well, and Andrew, you track this every week with your great videos. I mean, most people remember it just back in last May, when all of a sudden the Shanghai price was about $3, more than 10% higher than the COMEX, and you started to wonder, well, who's really got the pricing power here? Because you can't, if the Shanghai price were to go to 35 and COMEX still at 30, and you're like, well, wait a second, what's the real price? They got to somehow keep them closer together. And so you wonder, will we get a couple of other surges like that, even in just speculative buying in China this year with this moderately loose policy? What if all of a sudden there's a big surge on the Shanghai exchanges of new speculator buying?
And there is, because
there you go.
if you look at the data reports from the Shanghai in the last couple of months, and I noted this on a video a few weeks ago, as a percentage of transactions, the Shanghai has a higher physical percentage. I think in gold it was 78%, and silver, I forgot what it was, very high. But then in the last report, I think in December's report, those had come way off, meaning is more speculative positioning going on in Shanghai. As a percentage of transactions, physicals come down. Why? Because all that paper's entering. So you're starting to see that paper entering the Shanghai market. It was in the last data report, and I don't know if when January's out. It's probably not out yet. But they do those reports every month. You can look at them on Google and pay attention to the percentage of physical delivery. And not only had the percentage gone down to physical delivery, but the amount of trade, the notional trade, had gone up as well. So that's people coming in speculating on that market. Is those people in the West speculating on that market? Who's doing that? Somebody's coming over. Well, and we also seen a little bit of dip this year, dating back to the summer, in terms of COMEX trade as well. So maybe that's signaling a shift, from west to east in terms of that speculative positioning.
And think of it this way too. The Fed floods liquidity, and all that ends up in all of our markets and all that. And we know it's not gone into gold and silver. The mining share has been in Bitcoin, and all in the big 7 or whatever they're called, and all that kind of stuff. Well, they can't trade Bitcoin in China, can they? Yeah. Right? Isn't it a little illegal? Do they even have
to be able to? Yeah.
Yeah. Okay. So China issues all this moderately loose liquidity. It's going to go more into, again, silver contracts in Shanghai, gold contracts in Shanghai, copper contracts in Shanghai. That's where that liquidity is going to flow there. And again, forces the banks to go, oh man, what are we going to do here? They have to let price rise so it doesn't get detached. So again, all part of these forces that are underlying the markets is here as 2025 begins.
The hidden forces behind gold price manipulation highlight the lack of transparency in financial markets, with mainstream narratives often masking the true dynamics. While bullion banks and financial entities continue to exert control over gold pricing, savvy investors recognize the significance of understanding these mechanisms, especially as the growing demand for physical gold and shifts in global economic power challenge traditional pricing models. Suppressing gold's true value, often obscured by artificial manipulation, is a risk for those relying on paper markets. By investing in physical gold and staying informed, investors can protect their wealth from these tactics and take advantage of the opportunities created by the inevitable market shifts, positioning themselves for success once manipulation schemes lose their influence and the system undergoes a more decisive transition. If you found this message compelling and enjoyed the video, be sure to give it a thumbs up, share it with others, subscribe to our channel, and turn on post notifications for more thought-provoking content. Thanks for watching.